What's up, guys? Good morning. Smash that like button. Let's get ready to go. Good 3 minutes still open. Resilience opening negative today. All right, what's up, team? Let's get ready to do this. How y'all doing today? How's the music? I swear, every time I get on here, I have to change the music. Ooh, look at that sunset. How awesome is that? Windows. Okay, let's get Thinkorswim back up. Hold on 1 second. Where'd you go? Wait, hold on. Let's put you here. Okay. That's better. How are you guys doing today? All right, let's see what's going on. Bottom left. Let's check this out. Okay, that's cool. All right, let's look at this. Got our doomsday coming through. Yesterday we talked about DD as a pivot, right? You had that DD pivot tapped right at the bottom, return to the middle. This is that high volume pivot that we talk about, our indicators. This is from our risk interval indicators and exploit of margin requirements. So there's always a high volume pivot. You can see the bottom of my screen right here. We circled it while we were live on that podcast. And it's always a high volume interaction, maybe not necessarily a pivot, but that is that target that we talked about. So whenever the rules are that we have is whenever you open inside of these bands, which we are opening inside of these bands right now, the market opens rational for the day. When you open rational for the day, there's a neat little trick right up here when the numbers come in, this DD number right up here. When it's greater than half, the market tends to want to favor the upper band. When it's less than 1/2, it favors the lower band. So if it hasn't touched either band, then that is a trade idea, actual trade idea that's supposed to take. What up, China? Good morning. How are you? Oi. Did you hear about the Southwest Airlines thing? My trip to San Diego is likely to get canceled. Not because our flight's going to cancel, but everybody that's going to the party is getting canceled. So we might be the only ones there. That sucks. But hey. All right, let's see markets opening. Let's see if we get anything coming through. All right. This is looking pretty promising. Let's start at the top. Resilience right now is positive, so anytime resilience is positive, that's a pretty good sign that half gap is support. So right out the door, we have half gap support inside of a liquidity pocket. So anything that touches the middle is going to be 100% random from here. As soon as you, well, actually, as soon as you hit one of the walls and tap the middle, the market is statistically random from here. You can't decide. This is a balanced market. We've opened flat. We might stay flat. So resilience is going to be all the thing that matters. So watch out today. This number is above 0. Give it like 5 minutes to settle out. And if it's above 0, so again, we just open, let it do its thing for a couple minutes. If it stays above 0, it's quickly moving, right? So let's get out classic apps so you can watch resilience in real time. This is kind of what you want to do. We put in a ticket actually for our development team to actually make the rocket scooter tick by tick indicator come through. Okay. So when you're looking at a chart, right, any indicator that's on the chart that's underneath the candles is matching the pulling interval of the candles, which would be 1 minute. So it's only showing you like however often these candles update, this will update. So we actually have another widget that we're going to make, this little guy right here. This is the real-time resilience. So every single ticket updates in our server. And I think we refresh this like once a second or something. We're going to have a little resilience right over here, a real-time resilience, so you can get a little bit more zoom in on this while you're trading live. So you can see, I'll put this here since we're just now opening. It survived the 0 and stayed positive, which I say half gap again is support, and there's proof before your very eyes what resilience actually does. Pivots half gap to the close. Now, the closing price, it looks like it's likely going to be, let me get over here on my chart. I love this indicator so much. It's going to, oh wait, let's go back here. Here it is. Right about here, 381.39. So it's a really small distribution zone, so it's actually not that far at all. It's literally opening as flat as it can be. So you guys see how this works? All right, let's go really quick. Refresh this. Okay, so anything that breaks into 383 is a bull breakout, so that's what I'm going to wait for. Again, you have to pass your liquidity pocket. So inside of here, it's going to be hard to break out. Anything that I would possibly do on the S&P would be, as long as resilience stays above 0, if I'm selling options, I would sell options. Outside of whatever this expected volatility is, the distance between these two things, if you're taking notes. So we're talking about like a 1 point expectation. So anything that's below 1 point, and usually double it to be a little safer, is if I were to do a vertical spread on puts, I would buy puts right here, and I'd sell puts 2 points lower for 0 days. So today, if you want to break out 383 on the breakout side, recalls SPY, let's give EXY. It's bear long up. So what you guys do is you go to the liquidity map. This is available in our Discord. Let me pull this guy up really quick. Oh, let me open up a new tab. All right, so liquidity map is here. The letters at the top. Hold on. Let me. Never show. Okay, that's better. All right. So right here, we have bear long up and bear long up. Bear long up is interaction with hedge pressure is the only pivot that I can see on the VIX if it doesn't go straight up past the open. So if you open here and you continue to rally on the VIX, it goes to the next resistance. If it's a bear long up, we look for it to interact as long as the opening price is not support with volume, then it can slowly drift down to locate wherever hedge pressure will be. So with UVXY, no clue where hedge pressure will be. Let me see what it says. Way down there. Wow. Okay, so it's really far. Okay, cool. All right, so that's good. So this is good for VIX decay. This is great for a bull side run today. I would be super greedy. Bear long up on QQQ. Let's take a look at this one. Bear long up, the same thing. If you open and supported the open, it goes to your next resistance. Your next resistance is a liquidity pocket here. So the trade from here to here was a long scalp out the door. Rocket scooter straight up. Liquidity map is good. If it does break through and keep going, normally what I do if I was long here, trim there. If it continues to go, this is the upper limit of the day. 270, not breaking that. So without a catalyst, that's pretty much the limit for today's run. Pretty good. Actually, let's tell my team here. Let's look at the DD number. It'll be on Classic app right now. It's a 0.96. No way. This is interesting. It's not showing up here because we didn't have 90% of the tickers come through. It stopped at 89.9 of all things. So Classic app will always have, again, the raw number. We consider it 90. Once you have 90% of the calculations done, that number anchors or starts showing. So it's very, very, very high. So anything above 1/2 touches that upper band, as we talked about earlier. So in the S&P, it's still play-by-play or NASDAQ, whichever one touches the upper band, or Russell first, that is the trade. And as you see, just like we say, rocket scooter stuff, resilience plus doomsday, dynamite. Market to there, and if I were trading long, I'd cut out there. MHP, yeah, so I'm, let me check on that really quick. Hold on 1 second. Wait a minute. Oh, wait. Hold on. Okay. All right. So right to here, this is very textbook today. It's interesting to see these MHPs very low like this. They are unusually low, so we're investigating to make sure we don't have any like data losses or anything, but it is what it is, right? Chart layout. So here's one thing you guys can do. Auto saving your chart layouts. This is a new feature that we put in there. And then of course, auto scaling. So auto scaling, well, when you load the tickers up, we'll show you like essentially all the data in one spot. Now, let me pop out some instances of this chart scanner here. So what I'm going to do is I'm going to make a couple versions of this off to the side. One of the features that they are making right now is to pull this right here. So the scanner is something that is a really awesome feature. So you can scan by these playbook liquidity maps that you want. So today's moves are up, right? Everything looks up. All of our indicators pointed up, out the door. Things looking great. So not scared of today's market. Again, it's still end of the year, so it's going to be light volume. You're going to see people likely covering shorts to take profit more often today than you're going to see people trying to short the market going into the year. Most of this activity is going to be just generalized profit taking. So there we go. All right, and let's do, okay, so I'm going to do a little scanner. I'm doing it in my top left of my screen here. So what I'm doing is I'm going to put a grid of scanners. I'm going to teach you guys how to do the scanner really quick. Now, first and foremost, we have a bull setup on the S&P today, right? So the way that this works, and if you guys want to do your scanner settings just like mine, and by the way, everybody smash that like button if you don't mind. Drop some knowledge bombs for you really quick. So SPY being a bear long up, one of the things you can do is you can match what the SPY is on the last two letters like you want all the long up cases, like a bull long up and a bear long up, and you get all the ones that have that similar hedging mechanic as SPY. You can also come through, and with DD being greater than half, what I do is I don't go look for shorts. Also, SPY being above monthly hedge pressure is bull structure. I, again, don't go looking for shorts. So we can do the ones that match the SPY up here. And then, of course, we can do all the other ones down here, just the less powerful ones, but possible breakouts. We'll watch those guys down there. Not too many of those. This one I really love to do. So if we go to strategies and you remove this, what we're going to scan for are MHP breakups right here and HP breakups. So these are going to be your breakouts that at the start of the day break through and create a gamma squeeze. So this one we call our gamma squeeze one. And the next one that we're going to do is I'm going to do my scalps. So the way that liquidity map works, I'll show you guys on my screen really quick. Right here, the scalps I like to do are in between yellow and blues on both sides. Bull long downs and bear short ups. Those are my favorites to scalp. So let's go top left to show you guys how to set the scanner. So I'm going to add to that BLD, which we already have on the first one, and BRSU, but with a caveat, we're going to come through here and we're going to add a few more parameters. We're going to do, for these, I'm going to pick, actually, let's just do, let me try something different today. We're going to find ones that have broken through half gap to the upside just to show an additional bullish mechanic. So all day I'm going to watch these. When stocks pop up on either of these lists, these are ready to go. This guy at the top are going to be breakout plays, so plays that are opening not so bullish, and then they get that hedging boost. This one right here is going to be a stock that just wants to drift to fill its gap. These are going to be your generalized plays that are going to be looking at the similar structure to the S&P. And this one right here, as you remember, these are going to be the other bullish ones that aren't like necessarily matching the S&P. So here what we do is we can sort by distance from hedge pressure. Remember these bull ones that we look for. Let's kind of scroll through these. And then you can get those numbers here, and it'll show you the distance from hedge pressure. So let's go back to the main play. So just to get my screen back front and center. That's how that works. So let's pull up something like Apple, for instance. And I'm gonna say, just in general, I'm gonna open up a ticket for this because remember we had a massive data outage yesterday. Apparently, we're reporting that our data providers, ever since the 22nd, what they're saying is. Since the 22nd, there's something weird going on with our data providers. So they're having some kind of issue. That's what happened yesterday. So things are back, but they're still a little funky. So we're going to open up a thing with them. And let me go really quick. 1 second. So right now, let's go ahead and focus on the indices today. And we'll show you guys some scalping tricks. Dude, these no copyright playlists have the goofiest sounding music sometimes. All right, let me do 1 second here. Alrighty. What's up, buddy? Good morning. Okay, so there's that SPY run we talked about, still going up to that liquidity pocket here. Keep an eyeball out for that display right here. So we're just gonna do indices, focus on this today. I think we're gonna have a flat, choppy day. It'd be very rare for this to break out into the let's go here, into the upper band. So like in this area, like where my mouse is. When you open inside of the band, we call the market rational, right? So in this particular sense, the S&P futures opens in a very tolerable sort of state. With that number, that ratio being 0.96, what it does imply is that this is more likely to touch the upper band than the lower band. So the way that I trade that on just that indicator alone is if I had nothing else. So you guys are using other indicators of your arsenal. Anything if I was to buy right here, clearly the reward is smaller than the risk, right? The idea that it would fall here and likely save as part of that entire phenomenon. So that doomsday number being greater than 1/2, let's review where that is. Let's go to the center. So at the top of the screen, if you see right here, this number is it's a bias of how many of all of the stocks in the S&P 500 that are non-mean reverting, which means non-liquid. So all the illiquid stocks, we match them in a ratio of the illiquid bullish ones to the total of the illiquid bullish and bear. So we remove all the ones that are liquid. Liquid stocks tend to be random, right? So we move all the random balanced ones out of the way, and we just pull the ones that are directionally biased, right? And so this says of all the stocks that are directionally biased, 96% of them are directionally biased to the bull side, which is a huge up. So the rule we have with this number, there's a video called Doomsday that'll tell you all about it. Those of you using Rocket Scooter will know. If it's greater than 1/2, then the S&P futures are likely to touch the upper band. And SPY tracks the futures and QQQ tracks the futures. They will all pivot at the same time, or they track the index, which the futures tries to forecast. So they all tie together. So necessarily you will see that when this is greater than 1/2, the probability is higher to span the upper band than the lower band. It's a trick of volatility and margin requirements. It's a very cool exploit that we created here. So let's go to that screen really quick. So again, 0.96 implies that from where it has a higher probability of wanting to go up because the more the stocks are bullish. So we eliminate the market cap that is non-directional and liquid. You guys all understand what I'm saying? So an overwhelming amount of the stocks are positive, then likely it'll touch the upper band once before the lower band. And another little kind of asterisk to the trick is if it touches that upper band in the overnight session, that rule doesn't apply anymore. It still likely stays inside the band without a catalyst. So for example here, if it was negative, or sorry, if Doomsday was like 0.3, so less than 1/2, then the idea that it would touch the lower band before the upper band is what we would look for. So even if it was here and it was 0.7 or 0.8, you would say, okay, it wants to touch the upper band first, right? but music go. Like for instance here, say if it's 0.7 or 0.8 or anything above half, you would say, okay, once it touched the upper band at least once. But if it already did in the overnight, you don't say that anymore. You don't say that that's an option because it already spanned the volatility and tested that ahead of time, which is what futures tend to do. They try to make that test ahead of time. So if it doesn't make that test, it's always a trade idea, and we use that almost religiously here. So if any of the indices touch the band, all of them are eliminated. So it's the first one that hits that band. And the reason we only look at these three, again, is part of the sauce. And we completely ignore the Dow because the Dow is a completely useless instrument. It really has no predictability and no, it doesn't represent much of the stock market at all. It represents a handful of companies. And what you want to see is really money flowing into stocks in general. So the S&P 500 and the Russell 2000 are going to contain a wildly different array of stocks. And the NASDAQ is kind of like the little brother of the S&P. The NASDAQ will have some companies the S&P doesn't have, which is why we use that as well. The Dow Jones is contained. Every stock in the Dow Jones exists in one of these three indices. So the Dow Jones really has no pull or power. It's more of a psychological thing than anything. So we look at any of the three. If any of the three hit that pivot, you will see all three of them will react as part of the sauce. So you're going to learn a bunch of tricks you never learned before here. And so if you guys like what we're doing, smash that like button really quick. We have some weird nerd out there. I'm a weird nerd too, but some other weird nerd out there is directing a bunch of people to spam. Not a bunch of people. There's really only like 10 people, but they use bots that pretend like it's 1,000, and they just spam down click all of our stuff, but they're really dumb and understand that creates the same impression. But anyways, spam the like button if you don't mind. Do you know the YouTube algorithm, if you click the dislike button, same thing as the like button, they do nothing different. The algorithm. Saucy hate is just as good as content you like. YouTube loves that stuff. Okay, so are you looking for a pivot to get into the trade right? So today, right out the door with resilience being positive, I would have traded right first of the form, right out the door. So I'm not starting my trading challenge till I get back from San Diego. And what I'm going to do every day is scalping futures. I'm going to do my same small account challenge where, here, let me pull front and center. Same small account challenge I'm going to do that I did way back in the day. If you guys remember, I started with a trading account balance that was the same as 1/2 the margin requirement of the S&P futures. At the time, it was like $6,700. So what I did was I traded micros and I scaled the risk higher and higher and higher until I was trading minis and micros and then combining. And I think by the end of the challenge, I was trading between like 5 and 10 minis at a time. So we ended that challenge when we made that decision to pivot to rocket scooter. So it was like, okay, let's go back for a year. The very last stream, the account ended. The very last YouTube stream, the account ended at a high. So we actually stopped streaming on a high note. And then I went and developed rocket scooter. I was like, okay, this is working very well. So it's time to go to production. So then we created the platform from the smaller app after that. A little history lesson if you guys don't remember being here in those days. We had the classic app for the longest time, which has had all of our data and information. So you might see if your Rocket Scooter website will have 2 different apps. The classic app is like a condensed version of the Rocket Scooter app. So you get all the same information pretty much in a condensed fashion. So like SPY will show you where the zones are, where like hedge pressures and monthly hedge pressures and such are. So you'll get all that information in a more condensed version. And plus you get the real-time ticking resilience. So resilience updates every time we get an update of the calculation. So when you go to like any kind of candle chart or time chart, you'll notice that any indicator on your chart, let's say you go to like a 15-minute, is going to, we call it polling, I guess in numerical sampling or numerical analysis. Polling is how many times you take a sample over a time frame. So it's a 15-minute period where essentially historically it takes a sample every 15 minutes and prints the data. So you're not going to see the activity or history very well of resilience as you zoom out on a chart. So those of you that use like multi-time frames and stuff. So what we're going to do and what we actually do right now, this is resilience pulled every minute from the real data. So, you know, because it has to match, this is just the way charts work. So we have a real tick by tick resilience, which is really accurate. It's actually behind my head. Let's go over here. It's as quick acting as you can. This is taking a snapshot every minute to match the candles. This is going to be every time we get an update. I think it's like once a second. So you'll see how it just moves very rapidly. So this is essentially, in the meantime, we're going to get this little widget like down in here so you guys can watch it. Or just pop out the classic app if you really use resilience to scalp. So those of you that are looking at resilience just as a reference, this is good enough for a reference, right? Okay, I'm trading Apple, resilience is positive, I'm looking for half gap to support. Okay, good. But if you're actually scalping the S&P, you want that tick by tick resilience. Those of you futures traders, as I was telling you guys. You know, today we're going to talk about futures. So in futures, you want that real time, like you want to see every tick that comes through. So this is all 500 stocks. And what resilience does is it's an exploit of the stocks in the redistribution zone. We have this really cool video, and I want all of you guys to go watch this today. The redistribution zone is the ultimate scalping strategy for those of you that are in and out, in and out, in and out. It's not picking direction. It's not guessing the stock market. It's even better. Everyone out there that trades 10, 20, 50, 100 trades a day, especially if you're trying to scalp, you need to work on your gambling addiction. Day trading is not is not Call of Duty. It's not a video game where you get rewarded for getting 1,000 headshots. What it is you want to trade something that makes sense. You're not trying to guess the direction. Stock market is particularly based on human behavior, which is 100% unpredictable. If you don't believe me, go in there and call your significant other a poopy head and try to predict which side of your face they slap you on. You won't be able to do it. Unless they're right-handed, I don't know. Anyways, point is, you can't predict human behavior is going to do. If you did, that girl you loved in high school wouldn't have broken up with you that one time. You know what I'm saying? So you have to be very, very careful trying to predict what humans are going to do. Instead, we exploit mechanics in the market, things that are mechanical. If there's a machine that steers the plane to the right when a wind hits it from the left, we exploit that machine and know that it's got to steer back in order. And all of our indicators, there's 15 of them, each one does something very special and is an exploit of a mechanical system on the stock market. Resilience is part of the redistribution of order imbalances overnight. You guys ever hear, like on CNBC, oh, S&P closed with 300,000 share order imbalance on SPY or something, right? Those order imbalances are market makers either filling their pockets with a long or filling their pockets with a short at the end of the day and at the beginning of the day. And the net difference between those 2 days is the dealers are going to have one position that they don't want. They want to be neutral. So when the day opens, they spend their time trying to redistribute that position. Get out of the short, get out of long, and give it back to traders. They don't want to hold it forever. So in the redistribution zone, the open and close is an area of high resistance and support, because open and close are where the buyers and sellers were of the previous day. It's a very cool mechanic. Let me get my little pencil tool here. We'll draw it. So those of you scalping, this redistribution zone is one of the best things you can do. Give you a little lesson. And people ask, you know, is resilience, they ask if resilience is some kind of like breadth indicator or some kind of tick or trend. It is infinitely more sophisticated than that because it's repeatable. Tick, trend, all those things just reflect the live ticking values or the advancement of the price in real time. This is not the sum of price. This is nothing related to that. What it is a very, very, very kick-ass exploit. You guys ready for a little lesson? You need to add the liquidity map back to your chart, Darius, because I noticed this morning mine was missing too. So all the indicators on your templates probably got zapped whenever we released the chart layout autosave. So you're probably defaulting to a blank chart. Just make sure you add your indicator back to it. It's not showing up. I know mine wasn't there this morning either. So Okay. Hit F5 and refresh your platform. See if that shows up, Darius. Go here, indicators, and then add liquidity map like this. Add it to your screen. If you are experiencing any other display issues, go to the settings, Darius. Watch right here. See where I'm on settings? Click default, and that should refresh and reset everything. That should get you back going. If that's not the case, either reset your browser cache or open another browser. One of those things will fix it, I promise you. So try that, because what we've been doing to get you guys the data coming through faster, printed on the chart, we're doing some localized, saving of different things. So it might be in your local settings. So go ahead and clear your cache, clear your browser history. Clear your cookies, clear your cache, everything, whatever you got, and then try a different browser. Okay, so back to the lesson really quick. If you guys notice on any chart, I'm gonna give you guys a really, really, really cool lesson. Let's go to this little left chart here. This is gonna be like the mechanics of this scalping trick. And when I do my futures trading challenge, you guys will see most of the revenue and income I make from scalping futures is not picking direction. As a matter of fact, it's one trade that I get in and get out on usually. Like if I'll follow the playbook, if the playbook is a bull long up or whatever, I will usually trade, add to a position. I'll commit to a position and battle that one position and close out. I'm not scalping up, scalping down. The rules I usually follow are I'm one side only for the day. If I'm long and long works, great. If I'm long and it doesn't work, okay, and I close. So what I'll do this time is also do redistribution zone scalping just to make it a little more exciting. So I might do some longs and shorts just to add that feature to the platform itself. Yeah, Darius, just go ahead and you guys all try on a different browser and report your issues. It might be on Chrome. So people were reporting some issues with Chrome yesterday. If you can, do me a favor, take a full screen screenshot of what you see, dump it in tech support of your browser, and then say this is the browser I'm using. And if it is Chrome, it could be an issue with Chrome. So we did have a report that something kind of glitched with the Chrome browser. So feel free to do that. We promise we'll troubleshoot today. In the meantime, if you need a chart, you guys got me here. I'll help you. I'll get your chart for you. So let me show you something really cool on my screen. So does everybody see this little quickie lesson on scalping indices? Now SPY, everything looks nice and tidy. All the stocks are likely to drift up today and trade up. So no shorting. If I were trading today, no shorting on my books. So everything's looking nice and tidy and long. Okay, does everyone see? Check, check. If you are here and you're like, first week here or your first day here and you go, I'm ready for a lesson. Let me know it's your first week here, your first day here. Let me know what you trade. Let me know some stuff because I'll try to talk it in a language that you may have not heard or that other people may have heard before and really kind of go in and show you guys some cool stuff. Who here is on the free trial? First day scalping futures, awesome. Okay, cool. All right, awesome. Hold on one second. Okay, what do you? And if you're doing futures, what are you guys normally trading? You guys are gonna love these tricks, I promise. These are really, really, really. If you like scalping, you like trading a lot. This is one of my favorite things to do. And I can't wait to get started and show you guys this. I'd like to get started like right after the first of the year, so that way my trading challenge isn't interrupted by my week-long trip to San Diego. Just for New Year's. Just to let you guys know, when I did my trading challenge, a lot of people were here for it. I can get the results. If you guys want to see the results of it, I can get it out for you. So the trading challenge lasted for about 9 months. If you guys want to know, and you can ask the folks here, this was live streamed, for 9 months. I went on a 70-day win streak, live trading with the account shown in real time, the account balance and account history shown in real time, all the positions, all the entries, all the exits, and the account balance, and even the account number were all on the screen, and never left the screen. So this is one thing I'm very proud of, is the transparency we brought to that challenge. There was never a day where I mysteriously vanished. There was never a day where I was losing a trade and the power went out, or I disappeared, or I posted videos at like 2 in the afternoon and called it live trading, right? That's what sim traders do. Like, they pose as real traders. They disappear for like a week or 2 at a time because they were sick or whatever. I was there every day. I had COVID, and I still woke up to stream with COVID, which is actually kind of funny. So in 2020, I got COVID like in round 0 when nobody had COVID yet. And it was funny because two other people from our stream had gotten COVID at that same time. And they were like, very scared. And one of the guys called me. He was just really nervous. We were friends. We are friends. So we were talking, and he's like, "Man, I got COVID. I'm really scared. I'm scared for my family and things like that." And I'm like, if it's the will of the universe, for you to go, you got to go, but go strong, but you'll probably, how do you feel? He's like, "Oh, I feel like it's just like a flu and I feel all right." I was like, "Well, get some rest, eat some food. It's viral, so you just gotta wait it out. It's the universal. It's a genetic dice roll. Nothing you can do. Worrying about it will make it worse." So like, okay. And then like 3 or 4 days later, I got COVID, and I woke up every day, dead sick, streaming still to preserve the integrity of that challenge. You guys remember that? Just so people didn't say, "Oh, Matt left for a week because he was losing the challenge." I woke up like my eyes were draining. I just had to mute them. Oh, sorry, my mic is muted here. So sorry, I was telling you guys a story. Now I can hear the story as I'm literally talking to myself. So I did a small account challenge. I don't know how long this mic was muted for. Last time it was trading futures only. So you guys, at the start of the year, I want you to come watch this challenge. It's a day trading challenge, and I do it nonstop. Back in the day, I did it. It lasted for almost a year. The challenge had a 7-0 day win streak trading only. S&P and NASDAQ futures. That's it. 70 days, and it's all historically documented on YouTube. I could show you guys any day of those videos if you guys want to privately view them with us. They're all there, and so and then of course the account history was always shown. So the neat thing about it was I promised transparency. I started with half the margin requirement of the S&P at the time, and I said I'm going to start with micros and continue to grow the challenge. The account and show you how you would grow a small account. Over the course of almost a year, the account went from 6,700 to 95,000 live traded. It was fully transparent. The platform was on the screen. There were rules. I said my trading platform will never leave the screen. I said I will never disappear in the middle of the day. I'll never shut down the stream when I'm losing a trade. I'll stream from this time to that time every single day. Every position I held was on the screen. Every entry and exit history was shown on the screen. The account, the current positions were shown on the screen. The history of the account, the little green line, was shown on the screen. The account balance was shown on the screen, and even the account number, where I said you could call my broker and make trades for me because I didn't give a fuck that you can go in and hack me. Didn't care. It was for transparency. And even I had COVID, and I still woke up and streamed with COVID to not break my own rules of the challenge. So those people that were here that remember that are so excited to see me get back to it, because you see me talking a lot about the markets by demonstrating rocket screw. You haven't seen me show off any trading, so we're going to get to that pretty soon. Whether it's blow up the account or whether it's shoot to the moon, either way, you guys get to watch me win or lose with grace and style and with control. I don't recklessly gamble. Every trade I make is methodical and meticulously calculated for risk and reward. You guys are going to see some pretty kick-ass, hopefully, trading skills, even if I don't win or produce or the account doesn't grow, trading is like poker. You're going to get dealt some bad hands. There's nothing wrong with losing, but the trick to losing is the following. Say that you have $100,000. I'm going to get back to this scalping in the resistance, in the redistribution zone. So you have $100,000 you inherited from, I don't know, some royal family. You're like in the bloodline of some royal family and some king, bit the dust, and then all of a sudden you got a random check for $100,000. Like, I want to be a day trader. So what you don't do is you don't go throw that into a day trading account. You certainly don't go scalping yellow options with this thing. What you can do is do what I'm going to show you. Again, this is not financial advice. I can't tell you how to invest or what to do with your money. I'll give you a suggestion. There's a rule that says don't put all your eggs in one basket for a reason. So I want you to write down a number. Write down this number right here, 10. As a matter of fact, I want you to take a sticky note, and this is what I always tell people, is like, get some sticky notes or get a tablet and take notes, because I'm going to train you guys on a lot of stuff. I've actually been trading for a decade, actually over a decade. Before I was trading, I was a chemical engineer, and this group was started by a bunch of engineers. So we decided to take trading to the next level with a little bit of mathematical precision to what we do. Some repeatability and some rules, right? Engineers are nerds that thrive on rules. Write down on a sticky note and put it next to your computer, 10. Okay. And you might want to look at that number every single time you're losing a trade, because this is at the minimum number of times that you're going to blow up your account as a day trader trying to make it in this business. Okay, it's going to happen to all of you. Maybe 50, maybe 100, maybe one of you will be the Michael Jordan of trading, and you'll blow up once and figure it out. And that'll be 1% of 1% of 1%. Every one of you in here will experience 10 or more blowouts probably. Or just expect to. Maybe you won't, but expect to. And so tell yourself that's expected, okay? Just statistically, everyone blows up a bunch getting started. You don't know what you're doing. And it takes years to kind of like foster yourself into the mindset of being a day trader or being any kind of trader and investor. Now, if you're a swing trader investor and you don't play margin accounts, you probably won't blow up, but you're going to lose money for a while. But if you're trying to day trade, especially in futures, especially in options of all places, you're going to blow up a lot. Options, that could be 50. I mean, options are the hardest thing to trade if you're getting into it. So imagine you're going to blow up a bunch, and all of a sudden your Uncle Joe from your bloodline dies, gives you $100,000. Everyone in the family gets some money. You're never going to blow up 10 times. So, chop this up into 20 pieces then, so that you get 20 times to play the game. Because when you're trading, it's not really, it's not you winning that's carving you as a trader. It's not you losing that's carving you as a trader. If you guys listen to the Trading Camp podcast when they interviewed me, in reality, where you start to develop your skills as a trader is, this is your account when I'm drawing on the screen, is like you're like, okay, oh, I'm doing great, let me be reckless. Oh shit, I'm doing bad. Let me panic and do desperate things. Let me yell. Oh good, thank God, my YOLO paid off. You're doing stupid shit up in here. You're not really learning much. But in reality, it's like right here when you're like struggling to keep that account alive, and you're really like, okay, I gotta focus. Let me discipline. It's like this is where you emotionally shape yourself to do this job. And so your education really like exists right here. You're not learning anything here. So just imagine you're going to do this for a while and then knock it out. But this is where you learn everything about yourself as a trader. This is like practicing firing a rifle in a gun range. And this is like going into combat if you're in the military and bullets are coming back at you, right? You're going to learn if your hands are shaking in the middle of combat, you can't fire your gun straight. That's what you're going to learn right here. This is real combat. This is where you shape yourself. Can you do this job or not? And most of you jump in at COVID, post-COVID trading, and you like one, and this is you now, okay? If your trading account looks like this from like 2020 to like now, feel free to say, oh shit, that is me. What the fuck? You're just matching the market at best, or like your account is like doing this and you're just not doing well now because you essentially learned some confirmation bias in a bull market. You didn't learn how to trade a bear one. A lot of you guys now, right? Okay, so what you want to do if you get like 100K, right? And you're like, okay, I want to learn how to trade. You don't need any account minimum to trade futures, which is why I always demonstrate futures challenges. So why not start with like 5K? And that's what I always say. start with 5K and then try to grow it, right? If you don't grow it, then hey, it was a $5,000 education, like right in this range right here, which is good money spent. Some of your trading gurus will sell you, literally, they will take these indicators, put them all in a basket, and resell them to you for like 5,000 bucks. Okay, there's so much money wasted on garbage in this industry. Again, they'll take these indicators, change the color, mash 100 of them together, and put a price tag on it. And you go out there and buy that stuff. Instead, you know, wrestle with the market for a little bit, get your ass kicked. But get your ass kicked while you gracefully fight it and scale your risk accordingly, right? So now I get 20 chances to really learn how to trade with the money. That is indefinitely better than trying to make money as a trader. Your job as a trader is to not lose money. And the first stage of not losing money is not blowing up and going to zero, because without any money, you can't do any trading. We all got it? Go big old fat yes in chat for some good lessons. If you got it, you understand? Growing a small account is an art form, which says that no matter what, whatever hard knocks you ever experience as a trader, you lose it all, whatever, you can always go borrow some money from a friend and build yourself back up if you're good at this, right? What was that movie? Was it Rounders, the poker movie, where they were doing that? You guys got it? Okay. So start small, and futures allows you to subdivide your risk multiple ways. There's minis, micros, and even any nanos. So you can trade with like $1 at a time, right? Okay, so what the redistribution zone is, one of my favorite scalping tricks, and it goes as follows. So let me go over here to the bottom left for you futures folks here. So if you notice, the highest volume of any trading day, barring a catalyst, is always the open and close. This is the S&P futures at the top. So this is the S&P 500. And it kind of looks like a fish hook, like a backwards J, if you may, right? You can see that most all days look like that. And you might hear that, you know, throughout the day, market makers are trying to find liquidity, which means, imagine like if a buyer comes and a seller comes, they neutralize each other. But imagine, and we'll call that like zero. Imagine that two buyers come and one seller comes, and the market maker took the other side of the trade. And then for the next hour, two buyers come for every seller. Well, there's a buy imbalance, right? There's more buyers than sellers, which means that the market makers themselves have to facilitate that short. So now they have a short position that they need to unload because they want to stay neutral at all costs, right? So every single day, there's a MOO and MOC order that a hedge fund or institution can submit to a market maker right before the market closes and says, hey, I want to buy 100,000 shares of Apple at the closing price. I don't care what it is, just fill me at that one spot. The reason they do that is they get filled at one spot instead of trying to wrestle with the ladder and get filled at random prices because you're clearing out those tiers. You can say I need 100,000 shares at close, and the market maker will just give you a fair price and give everyone the same price. So this and this are those orders. This is the majority of your institutional positioning. They're not the ones day trading this. And I hear people always talk about market makers, this, that. These are all market makers and institutions' biggest trade takes place at the close and at the open of the day. Do we all see that and agree? This is 30 times the volume of the average candle. Your big boys play here and here, and maybe sporadically through here they'll react to news or trim their positions or whatever. Or dark pools are doing most of that activity, leaking stuff in and out. The majority of your institutional shifts are going to take place here and here. ETFs rebalancing, somebody adding to their portfolio, taking away from the portfolio, your 401k manager going out there, adding stocks, taking away stocks, whatever. So they all submit their orders. The dealers will take, say at the end of the day, you know, before you got 10-minute countdown, market's closing down, there's 200,000 shares to buy, some of everybody, and like 4 million shares to sell. And so the imbalance is 3.8 negative million. That's a huge amount. It's never that big, but I'm just making it for a random big number. So somebody had to fill that order. And so if you imagine the market maker being like a person with pockets like this, right, and then pocket this way and a pocket that way. So 3.8 million, which means they filled their pockets up with a short. In reality, they want to be as neutral as possible. So when the market opens, you repeat the same behavior. There's going to be that imbalance. They did the market on open orders, and they have an imbalance in the previous day, and then the next day there's a buy imbalance, say 2 million buy imbalance. Okay. So now they were able to take that 3.8 they held overnight and then 2 million bought, so the net is still negative 1.8 million. So for the rest of the day, the entire trading session, the market maker's main goal is to find liquidity so they can get out of this position and go back to zero before the end of the day. This happens every single day. Every single day. Now that mechanic can be overwhelmed by a catalyst or a change in sentiment or whatever, but anything that moves the market drastically on a sentiment change, which typically means people enter the market randomly in the middle, right? You'll see that things like this happen. There's sentiment changes or margin calls. So normally you'll see a normal day will look like this. If you see random one-off volumes in the middle of the day like that or like that, it's margin calls or squeezes. Typically big volumes come from people getting squeezed as markets are pressing against them and getting squeezed as markets are pressing against them. This is typically caused by margin calls. This is forced trading. Again, people don't want to trade big lots in the middle of the day because you're susceptible to really bad fills. If I had to sell 1 million shares of a stock, and I just brute force sell it to the bid, right? I'm hitting all of those tiers and I'm lowering the bid by selling, which means my average fill price is at a shitty spot. Nobody wants to sell to the market, ever. Nobody, unless you're an idiot. So the times that the volume doesn't distribute like this and has spikes, there's only one of two things that happen. Either it's a catalyst, either one, a dumb trader, or there's a catalyst, or it's a margin call, which is forced trading. So surprise sentiment or forced trading can cause midday volume spikes. And you'll see them like here and here. That's typically margin calls or forced trading. Let's just get out of the way. Same thing, probably margin calls, right? But most all of the days, it looks exactly the same, which is great because to an engineer, repeatable stuff is all we care to look for, right? So a redistribution zone is as follows. Let's pretend that day number 1, the S&P traded down. And this is day number 1. Put a 1 here. Okay. Typical day, no catalyst. Volume at the start of the day. Big volume at the end of the day, right? Okay. Day number 2, there was a buy imbalance at the open that offset the sell imbalance. So the day number 2, we gapped up. So typically when you gap up, the net imbalance of the 2 days is positive. It's the long side. People want to buy, so dealers gapped up to find sellers. People want to sell, they'll gap down to find buyers. Easy as that. So this is the open, and this is the close. And again, at the opening of the day, you have that same thing, and then volume trading. So you have a very, 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 very large volume of an imbalance of, at this particular place, people were, say there was a sell imbalance. People selling all day. So at the end, big sell imbalance. Let's put a short there. So there's sellers at this closing price, and there's a huge buy imbalance at the open, so they gap the price up and fill them there. So there's buyers here. The interesting mechanic of there being a high volume of buyers and a high volume of sellers is you have this huge zone called the redistribution zone where you have buyers and sellers, and the whole point of moving price around is to find buyers and sellers. So the scalping trick uses resilience, and it's as follows. Anytime resilience is positive, it's just a number, and let's go back to where resilience is on your screen. This number right here. Anytime resilience is positive, the S&P needs to move higher to some degree, whether it's one tick or a bunch of ticks. When this rate is positive, it means other stocks in this mechanic. Now remember, in this example, this is just SPY. But remember, SPY is tracking the SPX, which is tracking 500 stocks also doing the same thing. So what you'll notice is that anytime The halfway point is equilibrium between the buyers and sellers. We can hold it there all day. The buyers are upside down. The sellers are upside down in the middle, the maximum squeeze point. So dealers will hold it there all day long and make them sell at a loss or exit at a loss. So anytime the market is moving higher above half gap, markets race to find buyers or sellers. So if the market gapped up here and started lowering, then there were sellers there at the open. And from the middle, if there are buyers, again, it matches that high volume buffer of sellers. So essentially, just because there's high volume, that's where the market's looking to find buyers and sellers. That's all it means. So from the middle, if a stock is above its halfway point, it's likely to continue to move to interact with there. Again, as people are buying, they're going to make them buy higher because that's where they wanted to at the beginning of the day. They're going to continue to press those open and closed boundaries. You can look at any chart and you will see the same behavior every day. If you have a big gap, like gap up or gap down, you will see that the market will interact with the close price multiple times. Or here, the open price, again, is always a pivot. So if you didn't know that, this is scalping trick number one. The open and close price are always going to be pivots. You can't predict that if it's going to go up or down, but what resilience will do, will predict if the S&P is going to go up or down because the stocks are doing their thing. So if I show you a cool trick right here, let me just pick something. This is like it interacts with a lot of it. So let me scoot this to the left. It's a really cool lesson, futures traders. S&P QQQ today still looking nice and tasty. No signs of selling off yet. Everything's looking really solid. Rocket scooter, nice and pretty. So it's the equities close, which you're going to put right here at. I'm just going to draw a red line there, and let's find the opening price right here. I'm just going to pick, this is just the last random day I found. Okay. All right, now let me go back to a 1 minute chart. Let's just like really zoom in, right? And let's show the behavior against those red lines. You will see that that open and close price, whatever. Oh, let me see if I can get more data on here. You know what, 30 days, I think. Okay. So using Thinkorswim. Okay. I think that was that. Okay, here it is. All right, so again, don't let me steer. I just picked a random day that just was like a couple days ago, right? You will see that you interacting with this red line and that red line will produce volume spikes. I will circle. Again, it's predictable on a daily basis. The opening and close as a scalper are your best friends as a day trader that likes to fire off orders all day long. You cannot argue with what you see on the screen. Actually, let me just put a dot below so you can't see it. Look at that wick. Look at that wick. Look at that fall, test, fall. Look at that bounce and that bounce. Look at this crazy wick action here. Look at that crazy wick action here. The breakouts take place from that in support there. It's almost like, how could I have never seen this before? It might be some of your thoughts, right? Interact with there, volume spike. Interact with there, volume spike. Interact with there, volume spike. Interact with there, volume sporadically spiking, right? Even towards the end of the day or lunchtime, you still get volume come out of nowhere from breaking out of this zone. You guys see that, right? Okay. Can you post what you're experiencing in tech support, Darius? And double check that your membership is active. That's one thing we need you to check. So inside of here, so go to your dashboard and look. What you see is that the market pivoting between these levels is very solid. Above it, it's going to test it for support if it needs a lower price. Below it, it's going to test against it if you're raising price. So these are pivots just throughout the day. If you have a big enough gap, you can scalp this all day long with proper direction. And that's what I'm going to show whenever I start doing my challenge. And so the idea is that it's very simple. Now to just give a cool little lesson there. Back to the old drawing I did. Is that if the S&P is in the middle, And most of the stocks are bouncing off of their open and close price. Like again, if the Apple stock is right here and Apple stock starts trading, our algorithm will say, well, Apple needs to go to there to find sellers. So Apple has an implied move that hasn't happened yet. Meta's trading down, and then of course there is a move that Meta could go to find buyers. It's the move that hasn't happened. So say that you had a stock, very simple. A stock has moved to there. The S&P is the sum of all the stocks. The S&P will have moved down a little bit too because it's tracking. But the algorithm takes one step further and says, well, Apple needs to fill its gap. So there's like a move that hasn't happened yet. So the algorithm will say, well, the S&P has a value that it will achieve when that follows, and it's all weighted by market cap. So the sum of the implied moves will show a leading indicator what the S&P should do if it were to track it, and it always tracks it. So the rate of implied hedging, which means the market will hedge itself lower to find buyers, and you sum up all 500 stocks or 500 companies, if the S&P is undervalued or overvalued based on the moves that hasn't happened yet. So resilience is probably one of the very first leading indicators that you've ever seen in general in the market, because it's an arbitrage indicator. So what I do when I scalp with it, let's go back to the main course. Today, the redistribution zone is super small. The market opened here and closed there. There is literally no range to scalp. These flat days are just impossible to scalp. If you get 10 or more points in the S&P or 50 or more points in the QQQ, it becomes some fun scalping because you get enough run to make it worth your time. So let's go back and check on some things really quick. Let's pull up the, so today it doesn't apply, right? Because there's really no return to scalp between these ranges. It opened completely flat. So the half gap is the halfway point between the open and close, which is used for that particular trading setup, that style. So today, you can see that right about 9:26, we were losing resilience earlier. So right here at 26, the real-time resilience at this particular candle, right here, resilience is negative, which means this is now resistance to fill the gap this way. And again, it's a small little move, but what resilience does is it tells me what to expect. So right now, with this being less than 0, I'm expecting this to push down towards the open price. If this is positive, it pushes up towards the close price. So the real tick by tick res was showing you that the minute this guy goes negative, this right here is no longer support. So had I longed the market, I would get out of the way knowing I would get out of the way. Or if I long the market off a hedge pressure, I know that at best I'm looking for that to be resistance. So now I know reward and risk to my trade. It's like scalping today. If I did want to buy this dip, I'd long from like here to there and close it out, because I know that this indicator is telling me that we're going to stay on this side of that gap. So that's how cool that is. That's how easy that is. So today, like I said, there's no real scalpability because there's not a big gap. But if I go to show you any of the other ones, it's really cool to notice this. And scalping the redistribution zone is fun when there's 30, 40 points. We wake up and we'll go like scalp day, right? You come to the stream and I'll be like, hey guys, awesome, kick-ass scalp day today. Let's find one that actually moved as well. These are a bunch of flat days. But again, this is I'm just going to show you another example. It's just like 3 or 4 days ago again. And what's neat is that if this is your first time seeing an indicator like this, then we're really excited to share with you some of these new tools, right? An S&P pivot tool that forecasts where the S&P should go before it goes there, not based on technical analysis, based on the principle that market makers are trying to find buyers and sellers of that stock, and will span the gap in those high volume nodes to do that. And so that's just an example of how we construct our indication tools. That should show you the sophistication that goes into them. It's not moving averages and MACDs and colorful fucking triangles and squares and circles on your chart. like a children's coloring book, right? That's silly. No mathematician would ever subscribe to something like that. No computer programmer would ever think that that was a valid way to do data analysis. Quantitative analysis is not done with shapes and colors. It's done with numbers. Okay, here you go. So this is another, is this the same day? Did I just redo the same day? I don't remember if I did the same day or not. Oh, maybe I just redid the same day. Either case, pivot, pivot. Pivot, 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 pivot. Same stuff. Okay. We're getting reports about our data outage. Okay, yeah. Not a data outage, but they're having internal outages on their side. It's again our data providers. They're not supplying some of the critical data we need for our calculations. So unfortunately, that's why you guys are experiencing some of the stuff you're experiencing. And again, since the 22nd of December, they've been having a little issues on their end. We are literally calling them to find out what's going on. So again, like going through this, showing you guys some of these pivots again, same way. You can just see that this is over and over. This is open. That's actually kind of, let's pick another day and just show you. So scalping between open and close is such a fun activity. You can always frame your risk and reward correctly. You know exactly how much you're willing to trade, exactly how much you're willing to lose. You know how much the distance of spanning that gap is going to be. You can set your stop loss to always be in a place where your trade's always more than 1-to-1, so that you can control every aspect of your trade and you're not picking direction, you're just getting in, getting out. And it's a great way to play with a little bit of risk and have some fun while you do it. But making sure that everything you do is always calculated. So like I don't trade without knowing my risk and knowing my reward. Okay, so there's the open and close of the really substantial gap. We're talking 36 to 55, a 20-point distance on the gap on the S&P. That's lovely. Anything greater than 10, I love to play that game. Okay, let's go here. Here's the close at high volume. We gapped up. Here's the open at high volume. We gapped up on a buy imbalance. The net sum of the two is a buy imbalance. So we gapped up to see if we could find sellers. And as you see the opening price pivot with high volume, I mean, it's like once you see this, you can't unsee it. And I'm glad you guys are seeing stuff that has nothing to do with shapes, colors, and patterns that have never once made any of you guys any money. Trading, understanding the mechanics of the markets is exactly what we want you guys to do as traders here. Again, if you thought this volume stuff was random, now you're going to learn every mechanic of the market. Look, there is that interaction again with the open price, high volume spike. You can see it right here, right? Here's that interaction with the opening price, volume mound that just mounds up. Here's that drop to find those buyers. Look at all that volume as you interact with the open price. You understand there's another volume spike there, another set of volume spikes there, etc., etc., etc. But you see, this is the pivot that matters. The most important pivots of the day, if you write on your sticky note, are the open and close price and half gap, which is the price in the middle. No, today I would not take a long of a hedge pressure, not today. Only to resilience if I did, only to half gap if I did, and it's only 10 points. So if I did, it would be a small, actually I would do it, but it would be small, like a micro or a mini, just because. So do we all understand that you can't like unsee this, right? These are pivots that matter. So resilience is going to tell you if you're in the redistribution zone, I'm going to put a big fat R, is internal to this redistribution zone. This is the illiquidity zone, outside. So anything above here, buyers are overwhelming sellers because the most amount of buyers would appear at the open of the day. And if throughout the day, more buyers are stepping in, that was unpredictable because they didn't tell the market makers at the beginning of the day I wanted to buy. So market's illiquid, which means there are more buyers than sellers or vice versa. And market's illiquid down here. Redistribution zone is tasty scalps from here to the middle to there, from the middle to there, middle to there. And according to this one was a breakout day. So we didn't get any tasty scalps, but resilience has two functions. So our indicator will tell us, in general, oops, there's screen off, is that if the S&P gaps up, there's a half gap. And you'll see on your Rocket Scooter platform, you'll see the word half gap. Half gap and open and close are the most important, I guess, buyer and sell or high volume nodes of the day. Half gap is your most important pivot of the day. Let me just rephrase it like that. So you'll see HG on our tool is a white line. So anytime resilience is greater, if you're in the redistribution zone, which means you're inside of here, our resilience indicator floats around 0. If resilience is greater than 0, then the S&P wants to support at half gap and move to there from any place. If it's here, it wants to do that or go straight there. If it's down here, it wants to break through it and go there. So resilience pivots from open to close inside of that zone all day long. Number 2 is as long as markets are rational. If resilience is negative, half gap is resistance inside the zone. If resilience is positive, half gap is support inside the zone. So again, if you're below it and you get the support indication, it wants to go above it. So if it's negative, then it wants to resist off of it, which is where we are today. Today, resilience is negative, and the S&P is trading down to another support we have called hedge pressure. Different level. People are saying, would you buy up a hedge pressure? And because resilience is less than 0, then I tell myself half gap is resistance, so my reward maximizes there if I longed. And as long as my risk is less than my reward, I'll take the trade. So I'll set a stop loss to do that. Now this is a 10-point run, so I'd set a stop loss at 5 points down, keep it 10-to-1 trade, 2-to-1 trade. Easy as that. So going back to what we see outside the redistribution zone, a neat thing is that there's a second rule. And remember, inside the zone, it's wanting to pivot to touch that or touch that. There's another thing with res is greater than 0. Like res was like here, and it goes greater than 0. Then what happens is when you're outside of the zone, then the open becomes support as long as it's greater than 0. And it doesn't matter how much greater than 0. It can be like right here or right there at 100. It doesn't matter. Being above 0 just means that the seesaw that you're standing on has 2 buckets with like a faucet that's like dripping water on both sides, and the valve is slightly turned to the right, and it's dripping over here, and it's going to slowly be faster. This is real-time market cap entering the stock market, bullish illiquid, bearish illiquid. So illiquid on the index itself will track a bunch of stocks. So if res is greater than 0, the upper boundary is support outside of the band. And so what's neat about this is resilience also is used as an escape route. An example is, say that I long the stock market right here. I bought the S&P, the entire market, and all of a sudden res tests 0 and breaks through 0 while this is doing that. My brain immediately says, okay, half gap is resistance. Shit, we're going to there. So as it's kind of playing around, I can just exit my trade because the stocks have moved before the index has moved. So I just close out before I take the fall. So it's like an escape chute as well. So let's go back to the center on Rocket Scooter here. So answer some of your questions. Can you run backup numbers for IWM? It's too late, KR. I wish I could, but after 10 or 20 minutes, it's not really fruitful to run those numbers anymore. I will next time though, in the morning. My backup calcs of the prototype, you mean? It's too late to do it. It wouldn't give us much. Is it possible to combine manual analysis of liquidity map strategy and resilient signals into a buy and sell signal on the chart? 100%. The master plan of Rocket Scooter is to like literally have this particular layout. Okay. An example is, let's pretend that liquidity map all the stuff that we give you manually is eventually going to be on the chart in a very condensed manner, which is going to be awesome. So you guys supporting the group and signing up right now at the half price off forever. It's $100 a month for life. We love for you guys to support the platform. It covers all your real-time data feeds. It will cover all your options data feeds when we open up options trading and options ladders. You'll get stock data, options data, you'll get futures data, forex data, crypto data when we get that all on the platform for $100 a month with all the features and even all the new stuff we haven't made yet, like AI journaling, statistical backtesting and things like that. All these really kick-ass features will all come to you guys additional for free, and you want to have your price raised. So I think a full version of Rocket Scooter might be $300 if you bought everything with every data feed. So you $100 a month, early birds can actually get the whole platform that we ever make for that price forever, as long as you stay subbed, which we appreciate you guys supporting us. We're growing like wildfire. Got 100 some free trials this week alone. So like I'm excited to see you guys come and check it out for the first time. And it'll be even more exciting when you get to see me do some of my live trading, because we have a blast here when we do it. So the ultimate goal is to do a couple things. Like let's example for resilience. The white number matches the white line. And I'm going to go ahead and pick myself a layer. So let's just pretend for the sake of argument that this is the open and this is the close. Okay, we'll give it a bigger wide range. So anytime res is positive, what it's going to do is like draw an arrow on what it thinks it's going to do. An example being in the redistribution zone. Actually, let's start here. Right at this moment in time, it would draw an arrow every time something was going to change. So now we broke out of the redistribution zone. If res is positive, what it would do would be draw like a little arrow like that. For instance, to some area, just in general. So resilience is positive. Every time it hits a known support, it'll draw an arrow, kind of show you which direction the expectation of it is. When res is negative, what it'll do is it'll show you there's a change and it went to negative. Something like that. You hit a liquidity map, it will also draw arrows based on the expected flow of order, the expected order flow, right? So an example would be if we had a liquidity map that shows, and by the way, my liquidity map's not showing either, those of you, so we'll look into that. So right here, pretending that we had a BLD and it was going to hit hedge pressure, it'd be a green arrow to that yellow bar or to a resistance. So it would draw the same thing. It would say, okay, we're at hedge pressure. These are my options here to some resistance. Let's pretend monthly hedge pressure was here. So you'll see that like at this moment in time, you have a pathway that it's trying to draw. So you can get a quick reference as to what it's doing. Now it's not predicting the stock market, but it is showing you where buyers and sellers can be if the market pivots. You have to take it like that particular example. If the market's lowering, it's going to try to find buyers. Well, we know there's always buyers at hedge pressure. It's another one of our pivots. And again, when you touch hedge pressure, there's always high volume that appears. Again, another predictable high volume pivot. And from the start of the day, these numbers anchor themselves at 9:30, and they're there all day long. If you guys are taking notes, remember, don't trade in the last 2 hours of the day with liquidity map signals become fuzzy in the last 2 hour countdowns. The last 2 hours of the day, we don't do anything here. So up until the last 2 hours of the day, we will have like these pathways shown that says if the market falls and it's looking for buyers, this is probably where they'll be if they're anywhere. And you get there, and that volume came through, and as you see, when that volume starts to decay, whichever side of that pivot you're on is the side that usually wins. Right now, we're on the bottom side with volume and decline. This is not going to hold. So the way that we look for pivots here, any of the pivots, you do the same exact thing. Very simple process. You know that hedge pressure is always a pivot with high volume. There's before your very eyes right there. But when that volume starts to decay after a test or two and you've lost your volume, whatever side you're on just creates a cascading effect that'll move lower. So today, the combination of all of these factors, we might have like one indicator on the chart that would say the following. Okay, I'm expecting resilience to be resistance, and I'm expecting or hoping there's support here. And they can look at all the statistics and it might say like, have like a number here, 15%, 85%. To give me some weighted stats based on other factors that can say what's the probability I expect it to bounce or not bounce. And so that's the stuff we're going to write. Drawing the arrows with numbers next to them. How do you like that, Banta? That's the ultimate goal. So the first step is to get all 15 of our tools in the platform, which will take about up until the end of Q1. And then once we do, we're going to have some machine learning and some statistical presentation. Something like that, right? And so what we're trying to do is use the understanding that each one of the exploits, what hedge pressure is the net order flow maximum of market maker neutralization of the day. You can see that you have random high volume appear at this exact level. And all hedge pressures will do that. So if you have the sum of all your high volume pivots in one master indicator, essentially you're drawing a line from A to B with the probability at each interaction point. And like you can like literally map out your day. And that's what we call it a map, because a map, you're going to walk from A to B in a certain fashion, right? To find your treasure. And a map is just saying, if I were waking up at the start of the day and I was a market maker for a job and somebody said, here's your map for the day. This is where your market's balanced right there. This is where your bull imbalance is, or illiquid. This is where your bear imbalance is. That's all we tell you right here. This is your pivot to open and close. This is where you can redistribute your position very effectively if there's buyers and sellers sporadically at the same price you closed at yesterday. You can start unloading your long or short very rapidly inside of here. Here's the net sum of hedging. So if there is what we call the volume surge, once that surge happens in your decline, whatever side you're on typically wins the trade. So now volume is actually surging again to support above. So actually, it might actually hold now. So one thing I don't do is I don't bet on hedge pressure breaks. They're very rare, or rarer than the hold. So the idea that it is trying to break, up until here, I was thinking it was going to break, but now there's another volume spike. We got to play that volume surge game yet again. And so once that volume is in decline and we are above hedge pressure, it's likely to move to there. So in real time, the arrow, I'm just narrating what the computer would be thinking. So in real time, the arrow might have said, you know, down, up with a probability based on other factors. Again, right now there is no particular setup that I want to take, so I'm not even trading it. But ideally, that it would say, okay, here's the upside case, here's the downside case, and the probability is, you know, X, Y, or Z. And it will use statistical backtest basically to look for like other setups just like this where it did exactly the same thing. No catalyst, all the same triggers. Like we have a bunch of factors we look at, right, that go into the equations. And so pretend that we have like 15 factors and, you know, half of them are green, you know, right? And pretend that this was the layout. We look at volatility, options pricing. Was there a news event? Is there a catalyst? You know, essentially really sophisticated machine learning analysis. It's to say that our like flags or our history was like at this time, say that we had an identical day in S&P like a year ago. And the algorithm says this is the closest time we had a setup where all these flags are exactly the same. Stable market, rational market, no volatility of this, no VIX call wall, no hedge pressure break, no catalyst. You know, all the things lined up the same, and it would say, okay, how many times in history do we have a hedge pressure tap for S&P with those same flags? And it may say we had like 19 of them. I'm just going to make up a number. And of those 19, you know, 80% of them bounced under the same conditions. No catalyst, no reason to move, you know, no unusual volume, you know, whatever checks, right? So the idea is the ultimate goal of Rocket Scooter is to have arrows with probabilities fed by a machine learning algorithm that we are in the process of building right now. So the sophistication of what we've designed will continue to increase. So I appreciate you guys being part of this journey here. So from earlier, right? what is, ooh, that's interesting to see. Yeah, so essentially no, resilience is less than 0. The maximum upside is there. I'm no incentive to trade. And another thing to write down is anytime the market hits a liquidity pocket from the middle of the range, it is random from here as well. So the direction can't be predicted because this is another particular mechanism that we'll talk about maybe in the Zoom session today. So we'll get off of YouTube and we'll head over to Zoom and I'll show you how, from this point in time, we always talk about anything. So why the day's over today from the start of the day is my strategy. Other people do different strategies, but another thing is that in the middle of the bull and bear zone, you can see on my screen it says bull and bear zone. Let me just zoom out here. Anytime and if you guys want to take notes, another thing before I go is anytime you touch or interact with either edge of the zone, where the space in the middle is the liquidity pocket, we call it that. So anytime you touch either wall and hit the middle, from that moment in time, Rocket Scooter folks will tell you the direction is random, 100% random. No amount of relationships or understanding or things that we've put together has ever been able to predict which way you sway out of a liquidity pocket. So while pivoting resilience to open and close is actually highly predictable, it's very accurate as a matter of fact. People like to say around here resilience is never wrong, and it's a misnomer, but it's rarely wrong, for sure. Because resilience is the natural state of the S&P wanting to track the index. It very rarely will deviate from its job to do that. So this will tell you if it's not tracking, if the S&P is undervalued or overvalued relative to what it should be. So if SPY's trading up and resilience is down, SPY needs to get lower, and that's exactly what it does. And so this is different. Bear zone and bull zone in the middle we call liquidity pockets, the max amount of liquidity. An example is imagine that you bought a stock and your stock is winning. What are you more likely to do? Hold on to your stock as long as you're winning. The more you win, the more you're going to hold on. If you shorted a stock and it's selling off and it's crashing, you're more likely to hold on. So liquidity is two things. It's when a buyer and seller find each other, or a buyer and seller enter the market at a faster rate. So say that a buyer comes every minute and a seller comes every minute, offset by 30 seconds, okay? So, it's very slow. Every 30 seconds, someone comes to the game in general, and every minute a buyer steps in, every minute a seller steps in. So if you have more sellers or more buyers at that same interval, the market liquidity goes up. If you have buyers at a more frequent interval and sellers at the same interval, liquidity goes up as well. If you have buyers, again, if this matches that, then the liquidity goes up. If you have buyers at a more frequent interval and no changes to sellers, it's illiquid to the buy side. If you have the same interval, again, so liquidity is a function of time and frequency and amount. It's amplitude and frequency, right? Think of like waves. And so you have more buyers step in at the same interval, again, illiquid to the buy side. So as long as what happens to the buyers and sellers increases participation, the more traders, the more liquid. So that's exactly what we're doing when it comes to liquidity pocket. Is the idea is that liquidity is where buyers and sellers are entering the game. Well, bull zone are people that have already entered the game, and bear zone are people already entered the game as well. Previous positions that are still active at the open. So in a liquidity pocket, the really neat thing you may notice, and I like to challenge everybody to say, is imagine you are a bull at the close of yesterday's trading day. This is you right here. You bought at the end of the day. And all of a sudden, where I'm drawing is what the market did. Tell me really quick about your position right here. You longed here, and the market's now at the perfect spot of liquidity. So what you can do is turn on auto scaling, or you can just use your mouse wheel to do that. Today we're having some graphical anomalies because we're missing some data. Our data providers had a massive outage yesterday, and they're still trying to scramble to recover from that. So the auto scaling will typically show it all for you. Chase, down the road. So back to the example. Where's my music? Oh, it already ended? Okay. So back to the example, if you look at this liquidity pocket right here, is that the bulls, if you were bullish, you're going to be upside down. And if you're bearish, again, anybody that shorted anywhere in here is also upside down. So the neatest thing about liquidity pocket, you'll notice, is that this is the place where the most amount of traders are upside down in a trade. So in an illiquid trade, you're trading against the market maker on both sides. So this is market makers. If you're bearish, the market makers are bullish. If you're bullish, they're bearish. In the middle, market makers are winning against everybody on their trades. That's what you have to understand. And the bulls are losing and the bears are losing. So in a liquidity pocket is like the real max pain or the real max loss to everybody. It's actually the max. You might hear people say max pain is a very unsophisticated calculation that just sums up the open interest of options and tries to assume there's activity there. The actual real max loss or max pain of all traders is a liquidity pocket. Because what happens is, if you want to stir up liquidity, the reason that if I'm bullish and the market's going up, I'm likely not to act. Remember those arrows, right? There's not a lot of people going to act. If they're winning, they're going to hold their hand. And if the market's shorting, there's not a lot of people that are going to act. They're going to hold their hand. People don't like to do anything if they're winning or losing. They like to hang on to their position. But if you're at the maximum squeeze point where everybody's upside down, you're likely to have traders exit the game because they're closing a losing position. You're more likely to exit a losing position than you are to exit a winning position. There's the gambler's fallacy, the hot hand fallacy states that for people. Humans love to think that their win continues to win or their loss continue or their win continues to win. People are more afraid and will act on fight or flight when they're losing more often. So knee-jerk reactions just close out of the way while being upside down. So the way to stir liquidity up or to bring traders to act or to make trades, while you will be removing people from the game, you are increasing participation. So if you put it in the middle, there's a higher probability that longs will exit at a loss, or shorts will cover, or longs will sell and leave the trade in the middle. So the activity from the middle is whoever exits first tends to push the market this way. So in a liquidity pocket, the storybook tells you today, the market found maximum loss for all people, and then bulls just walked out of their position. It's not people selling or shorting the market more so than it is bulls exiting their position. There's two ways to support that if you're taking notes. Number one is, for the most part, whichever side it breaks to is typically the side that the other side exited. It's not new shorts. It's typically longs that are like, we're done. We're getting squeezed. And how do you know longs are getting squeezed? Because that sporadic U-shaped volume spike has random volume spikes in the middle of it that tend to be like very weird and just out of place, which anything that is weirded out of place like this typically means margin calls or squeeze. And we talked about that earlier today. So you guys are getting a crash course on all things volume and rocket scooter. Congratulations. The opening volume, which is typically the highest volume of the day, has been overwhelmed by even larger volume spikes with no catalyst. What is this all about? This is exactly what a long squeeze is. And now you know exactly the mechanic of the market. A long squeeze is not new bears shorting, because the new bears would have shorted usually at the start or the end of the day. Bears will take those opening, big bears, like big traders will take those positions at the start of the day. These random sporadic volume spikes are longs jumping out of the way before it goes lower, margin calls. So you don't wake up and say this is bearish, you say that this is longs dumping. While that can create a downward move, I consider bearishness bears entering positions instead of bulls exiting positions. So you can learn that through like rocket scooter. You can literally tell your friends exactly what's happening. Oh shit, everyone's bearish again. No, they're just not bullish, but they're also not bearish. They have no opinion, right? So the idea comes down to this. Bulls are people adding money to the stock market in a long position. Bears are people adding the money to the stock market in a short position. People taking their money back and putting it in their pockets are neither bear nor bull. So the market now found a balance point from the middle, and guessing which way it breaks, as we have proven with our studies statistically that it is a 100% chance from the middle that it will be random. 100%. This is one of the one certainties in the stock market, and I promise you guys, this is one of the few times I'll say it always works. Always, it never fails. From the middle, 100% of the time, the direction will be random. That is never incorrect, because it's humans deciding, fuck it, I'm out. Fuck it, I'm out. And you cannot collectively guess which hedge fund is going to either close their long or close their short, because this is based on their risk and their exposure, which you'll never know. They got fed up with their position. As you see, it's long, saying, let's just cut for profit. We're out. We're done. That's it. So it's pretty cool how you can make these kind of analysis and understand that a really good trader going forward is going to understand that this is your most important indicator that you will ever have. I use one indicator that the market has ever created for me. It's called volume. Volume is God of stock market. Not shapes, not lines, not stars I can't draw, not trapezoids, not, I don't know, you just bow tie. I mean, none of that, right? None of this, none of that. This is the most useful thing that tells you exactly what's going on. Today is the last day to cover short positions for the 2020 tax year. So you may see some sporadic activity off of that, and that will likely take place towards the end of the day. So far so good. Anytime you see sporadic volume like this, immediately you need to fire your brain on to say what's happening here. Cycle through. Was there a news event? Nah. Catalyst? No. Anything speculative and special? No. Oh, well, no. Wait, we did have a liquidity pocket that broke down. Okay, perfect. Longs are exiting. So if longs are exiting in droves, would I buy the dip? No. Right? So when you see this and you see the storybook, it tells you. And another idea I have for Rocket Scooter is to actually do this. To say, here's an alerts window, which is one thing we're going to make. Alerts can literally tell you in plain English, longs exiting. And again, you know that because of two things. Traditionally, at the maximum squeeze point, just human behavior says people are more likely to exit a loss than hold on. So if you're breaking this way, the longs are exiting at a loss and squeezing other longs out. And the evidence of that squeeze is the sporadic volume. So the indicator is the sporadic volume, this massive volume spike relative to the open. There's no catalyst here, and it didn't even move the price, just a huge order that was absorbed, right? So people are getting squeezed and exiting their trades. And so you will tell the storybook is that, well, if people are exiting their trades, longs exiting, then if I'm long, I should probably exit. And we do have a rule. If you're on the bull zone and you fall to the bear zone, don't be long. If you're on the bear zone, you go to the bull zone, don't be short. For that same reason. And so longs exiting is not shorts entering. It's not like, ooh, let me chase the short. There's no evidence of that right now. So in the light of what we do is the minute you touch that liquidity pocket, because 100% chance it will be random, is the minute you touch a wall and touch the middle, particularly me, my trading day is over for directional trading. So if I were to try to buy like options like puts or calls to guess the direction of the market, you are coin flipping every single time. I have proven statistically that it's random. No technical indicator will ever predict an equilibrium or balanced market where people are losing trades at the same rate. Who will buckle first? You can't predict that. Longer term swings, I have my buddy Ashton Nolan is going to be joining us in about a week or two, teaching you guys how to use a new feature we're making called Monthly Map. The Monthly Map is really cool. What we do is we can map out bull and bear zone at any point in time based on which options expire that day. So you can actually collectively draw a map of anything you're trading over the course of the month. So where's the bull zone and bear zone over the course of a month, and does it get more or less volatile? So long-term swings, for instance, Bright, are you trading options or are you trading stocks? This is your saying swings. I'll walk you through a really cool thing. And I'll manually draw it because we're building this feature probably in the next 2 weeks. Either even futures. Okay. So number one, and I'll tell you my rules in general, is I never. Actually, let me just make a blank chart. I never swing short, no matter what. Like never. I never will swing a short. Shorts tend to like, you know, consolidate. As soon as I get my big short move, I always exit any short that day. If I hold a short for multiple days, I'm not trying to short the market to trend lower. What I'm trying to do is short for a scalp for that day, or if I'm shorting by like buying puts, the minute I get my sell off, I'm done. So if I were to buy puts, for instance, and it's like I'm just hanging in there and I get that big sell off, I would exit that day. I don't ever swing a short because shorts have a different mechanic than longs do. So the two different mechanics I teach is I don't swing shorts, period. Like if I had bought puts and then bought some more puts and then I get my big sell off and make that money like that day right there, I'm done. I don't short for long periods of time because your premium will decay very fast on option shorts more than they'll decay on long shorts because of volatility crunch. So you'll notice that I will never swing trade a short for multiple days, but always long swing for multiple days. What up, Matt? Futures are different, so they have no decay in futures. So let's talk about that, right? So monthly map is an example. Let's just do let's do QQQ. There's a nice clean chart, QQQ, and I'll show you what a monthly map actually does. Let me see if we have enough data today. So our data providers are battling a data outage this morning. Okay, so what you can do is today is December 28th, right? We have an expiration today, and I can actually go into what's called single date, and I can run that particular date. That particular date is going to tell me what today actually looks like. So I have the risk spread for just today's options. And the way we calculate that these are options actually held by market makers. That's really what our sauce is here. This is market maker positions against the rest of the market. So we're highlighting illiquidity for you so that you can find those imbalances that are really there. So a good thing on monthly map is every time there's an expiration, you can plot out what that day looks like. Let's look at the 30th, for example. Okay. And actually, let me go ahead and let's do it like this. And the monthly map will be like a one button click on Rocket Scooter, and it'll be done for you when it's done. And it will kind of draw it like this. What you care about is to know where the bulls and bears are positioned over that course of time, right? So an example is on the 30th of Friday, I'm just going to use these boxes to kind of like draw this. You can see that above 278 and higher, it's all calls. So I'll just like draw a little box right here, right, for Friday. You see this? 278. And remember, guys, go to rocketseer.com if you guys want to check out the free trial. It is free. There is no credit card required. You can play at this platform for 7 days. And like I said, when the monthly map comes out, swing traders, y'all are going to love it. I promise. This is a good... What up, guys? Okay, here you go. Okay. So this is all, I'm going to use this like dark gray for calls and this light gray for puts. As you can see that below 270, it's all puts with no calls, right? That's what I really care about is like not the clustered up zone, but where the straight bears are and the straight bulls are with no counterpart, right? Just straight run bear, straight run bull. So 270 and lower, it's certainly bearish. So far, so good, right? You follow? There's a couple rules I want you to jot down. And let me just do 2 weeks out just so I can give you a little bit of a framework. Let's do the 6th. And on the 6th, it's the big split is at 276. Let's just kind of draw that for the next Friday. 276. And like I said, it'd be great. As soon as Rockseer draws all of this, it'd be phenomenal. And we have challenged the team to make this right exactly right now. Okay, there we go. So far so good. Okay. So right now, you can see that going into Friday, we are certainly in the bear zone. And I'll just some text here so you guys can see that, right? You have all kinds of puts in the money, right? So the QQQ is not bullish. On that Friday, at this price, and it's not bullish on that next Friday for that price either. The only time it's bullish is if it's either above here for that week. And this is one of the awesome things that you guys are gonna like. Because when I do all of my hedging and all of my swinging, it's always done with this technique. And now we're gonna actually draw it for y'all. So an example is if this is just holding right here. It's not bullish at all unless today it goes to here and higher, then it's bullish for Friday. So what you do is you make a matrix and you can say you are not. Okay, this is it's a little matrix, are not. Are, you can say bull and bear. Okay. If you are bull, you're going to long a call, right? If you are bear, you're going to long a put. If you are not bull, you're going to sell a call, and you are not bear, you're going to sell a put. So far, so good? So the bull side is I'm going to buy a call because I want to be long. If I'm not bullish, the market's not going to go up. I'll let you take the gamble that it will be long, and I'll make the money if you're wrong, right? Selling the call. So right now, we are not bullish. Selling calls for that strike at that point in time. The distance here is the expected range, better than any other calculation you will ever know that tells you the expected range of the day. The distance between here and here is the expected volatility of that week. It's a very cool mechanism. And if you don't believe me, this distance right here is containing that volatility day after day after day. It's no surprise that this distance is that distance and that distance and that distance and that distance. Isn't that cool? So something's going to happen this week that's going to make the volatility go up. Whatever this week is going to happen, that range is expected to be achieved, whether up or down or in the middle. So something is happening at the first of the year where that volatility should shock you and say, oh my God, there's some volatility being priced in that week. Do we understand? If the bulls and bears are so far away, imagine when I told you like in the middle, bulls and bears are upside down and squeezing. They're not that upside down, but imagine the middle here. They are crazy upside down. Look how upside down, everyone's so out of the money. So the less liquid, more upside down, the higher the sporadic craziness is, right? So in earnings season, it's the same way. Say that we had earnings report this week. The distance between here and here is that expected move before earnings. It's another trick we do. We do have a trick for everything. So if Apple was here and that was the distance, Apple can go up that distance or down that distance, and that's my expected range. I can sell options outside the band. Most of the time it doesn't achieve. Another trick is that you can so you see this right here, right? Pretty cool, right? This distance happens to be like that expected travel that you see almost every day when you consolidate, especially, even today. Not much different than that. It was like 8 points in QQQ. So now putting it all together, if this is the price we're at and I wanted to be bullish the stock market, at no point in time is this price bullish for 2 weeks. So I don't have calls that are long that expire in that 2-week range. Could it change after the 30th of December? I mean, it changes every day for millions of reasons, so it'll change every day. But the walls will adjust every day, so when you wake up every day, you redo your map. So today, and you say, okay, what position are you in Qs? I'm more likely to be in a not bull position or a bear position than either buying call. So nothing today from this price. If it's bearish, then having puts for this week, are bear, we are bear, I'll have puts for this Friday. Or I can take the am not bull and sell calls above in the bull zone, because again, it's not bullish. And I would use today's liquidity map to directionally use those pivots to get in and out of whatever side of a trade I want to be on by today's liquidity map. So say today's an example would be like, say that today's liquidity map has a monthly hedge pressure right there, okay? So I know if the market's selling off, I'm just going to wait, and I know that it's likely going to bounce a monthly hedge pressure. Right? So as it's falling, puts are becoming more expensive and calls are becoming cheaper. So let's say that I wanted to become YOLO and bet on some news event becoming bullish, right? How would I do that? So what you do is you know what you want to do, and then this will tell you when and where you should do it if you care about matching your trades to the sum of all institutions that are trading against the market. This is your big money spread. This is your big money shorts and your big money longs are divided exactly here. This is all your institutions in this risk. Do you want to bet against all of them and be bullish? Do you want to stay on the bear side and bet? Okay. Again, I don't buy puts for the long haul. I don't like doing that. Instead, I'd rather sell calls in the not bull zone. So the trick is a day trade today, let's just do a speculative naked sell. If this distance, I'm just going to make up a number, looks like it's 8 points, then what I do is I add that distance to the bull zone to add a little fat, and I'm going to sell calls all up in here for that Friday. Anytime the market spikes and doesn't break through here, I'm going to sell a call when it's expensive. And just expect the market to not break through out of the bear zone. What's the probability of that? Well, the S&P in our back test, from any point until expiration, there's only been a 4% chance that there was enough, again, 4 days out of 100, that you break from one side to the other, and usually requires a catalyst. All of Wall Street doesn't collectively change their mind without a big enough reason that you won't hear every person on the news talking about it. So as long as there's no catalyst, market stays the course and typically hedges along the course. So here's the thing, right? You got that long scalp on DD? Nice job, nice job. Okay, so in this particular example, the market is bearish but has upside to there with a 96, if you believe the stats, 96% chance it doesn't break, right? Without a catalyst. And again, that's just on the S&P. And it's empirical, so don't think stats mean anything. And the back test is just a back test, but it's enough for me to say it's tilting the scale. It's more likely to do that at the highest case upside scenario. The market is more likely to do this than anything up in here. Okay, so this is highly likely to finish the week off today. Any one of these is true. So the market can be flat, it can go up and come down a little bit. Hell, it could even end up higher than it is now, but chances are it doesn't break through that zone. So buying puts is kind of dangerous because it could go nowhere or even go up, so you can lose, lose, and lose. But selling calls is the more probable trade for the swing. And I can also sell them 2 weeks out if I wanted a slower theta burn. Because no matter what it does, I don't expect it to break, so I'm more likely to take that trade than anything else. And as an example. So what if I did want to long the market though? Okay, well, if I wanted to buy calls, but we're in the bear zone, I need to sell some calls to make sure I buy those calls for free. So now credit spreads are where it come in, right? So say that I'm going to sell a call for this strike right here. And so you can do it a million different ways. When I swing trade, in general, I'm going to use the liquidity map that's going to have one of two things. Number one is every day I'm going to wake up, I'm going to use that doomsday band to decide if the market's rational or not. If it is, then I'm good. I'm gonna look for monthly hedge pressure, which is the next thing. If you're below monthly hedge pressure, I'm looking to short. If you're above monthly hedge pressure, I'm looking to long. And that is what we call structure. This is structure for the course of a month. So that's where swing and investing is good for. You just look at that number alone. If you're below monthly hedge pressure, you tend to stay below it every day until there's a catalyst that breaks. So it doesn't almost never breaks without a reason. So QQQ today, 274.5, we are clearly below monthly hedge pressure, okay? It's right here. So I wake up today and I said, oh, I'm looking for shorts in general if they're available. So now I am bearish or are looking for shorts. Now I can buy some puts. So any spike that comes up, I can buy puts because we're in the bear zone. It's not going to spike likely outside of the bear zone. And you can see today, yesterday, and the day before, didn't spike out of the bear zone. How cool is that? 96%, as we keep saying. Over the course of this week, this wall has pretty much been the same. So it spikes, returns, spikes, returns, spikes, returns. And that's interesting. There's been no catalyst, no news events, no nothing. And the market just ebbs and flows on autopilot. You guys are seeing all these cool tricks today. So as a swing trader, you are bear-minded probably. If you are, I'm not telling you what to be, but below monthly hedge pressure, I'd be bear-minded. So if I'm bear-minded, I'm also not a bull, so I can do all kind of complex trades. What I love to do in the bear market is I love to sell calls on the bull side to bet that it doesn't just spontaneously become bullish. But I make sure that I don't naked sell, so I'll buy some calls right here and also some calls right there and make sure that the established trade nets a credit, right? This makes money, this costs money, and I can establish like a 2-to-1 credit. I can literally tell myself I want a $5,000 credit on this trade, set it up, boom. If the market breaks out of this and that small percent chance, then I'm covered. I can long the market. If we break to the bull side, I'm long the market there too. These calls are going to pick up delta very rapidly. And as long as these calls don't strike in the money, then I not only make the credit, but I make the delta on that trade as well. The ideal spot for that setup would be the market goes to there. These expire worthless, these expire in the money, okay? But even so, establishing this credit, I make money if the trade goes nowhere, up, down, whatever. Any of these things, I make the same 5,000 bucks, no matter what it does. And that's why trading options on swing trading with a complex structure is a lot more, if you know what you're doing, it's a lot more sophisticated and harder to do. But if you know what you're doing, you don't have to pick the direction of the market. This particular thing is just telling me no matter how the market moves, as long as this is not achieved, as long as that doesn't happen by expiration, then I make 5,000 bucks, no matter what. The credit is fixed. At least 5,000 bucks. If we go here, I make more than 5,000. If we go here, I make maximum amount would be I close 1 penny below this level, and this makes a ton of money. So not only does that credit spread give me money no matter what the fucking stock market does, I don't have to pick direction. Do you understand, Bright, and other people here? That's the beautiful thing about options if used correctly, not to YOLO scalp, but to trade options like a real institution would, is that you create a protected trade that by design is not picking direction. It's saying as long as it doesn't go there, I'm good. If it closes down here, then those lose money, but those made money, and I established that was the credit at the beginning, so that's what I get. So complex trades are the best way to bear market. My buddy Ashton Nolan is a monster educator on this particular style of trading. As you see, you don't have to guess which way it goes. That's harder to do, but you can guess that it's likely not going to go there or higher, right? Do you see how that's a little bit easier to assess? And that's the last thing I'm going to do before I get out of here. Everyone understand this lesson today? So the idea is that you can create, and then so in the day's rocket scooter is allow you to even fine tune this further. Like right now, I can establish that credit. Okay, but what if I knew that MHP was here and hedge pressure was here? And lucky for me, the market rallied to MHP, and I'm like, okay, it's going to resist. Well, calls just went up in value. So as the market legs up for this day's liquidity map, I can actually get more bang for my buck. I might be able to get a $7,000 or $8,000 or $10,000 credit for those same options. And the market falls to hedge pressure, where calls are cheaper, and then I leg in on the bounce. So the idea is that now if the market has like this, like as I was saying, is that the day's liquidity map for a swing trader, you're used to enter in at the right time to even get better bang for your buck. And that's how we call legging in. So if the market, again, we're flat and say today, all of a sudden I ran to monthly hedge pressure and we're sitting there right now. Market went up. Call values all went up in value. So I want to sell when the calls are expensive. So boom, I hit that and I'm going to bet that monthly hedge pressure resists today. So I sold those calls. Now I'm in a naked call short. Just remember, naked, be careful. And in that situation, anytime the calls I buy go in the money, I tend to start closing the calls I sold. I don't like to hold a credit spread until it closes. The instant we get a catalyst that scares people to bullish, I'm gonna nuke those anyways, get out of them completely. But anyways, say that I hit a monthly hedge pressure for today and I expect it to resist. Okay, so calls just got really good. Boom, I sold calls and sold calls. And then say that it tanks all the way to hedge pressure today and starts falling. These calls are already making a little bit of money. The premium, I've capitalized on some of that premium. And then all of a sudden we're at hedge pressure on the low side. Now these calls just became really cheap. And as time has progressed, they're closer to expiration, which means they became even cheaper due to theta decay. So every moment that ticks that these calls are not in the money, they're going to decay value even so. So if at the end of the day it falls to hedge pressure, those calls became cheaper just from theta alone. And if it falls, they became cheaper on delta as well. So now we fall to hedge pressure and maybe it bounces and holds flat, and then I bought these calls when they were cheap. Sold those when they're expensive, bought these when they were cheap, and now I legged into a spread at even better sophistication. Now, again, there's more profit in that, but again, you take more risk for more reward. The more risk is for a moment in time, you're in a naked short, right? So you understand more risk gives you more reward. The counter to being in a naked short is if this goes through here, close them out and just take the loss, right? Or buy the calls to jump in the money. Either way, you can use today's liquidity map to leg into Friday's close or even next Friday. Let's do one more example. How about next Friday? Let's share, and I want everybody to participate. I'm going to call it a day, and I want y'all to do a rocket scooter really quick. Now, the platform is going to draw this for you guys. And like, essentially do this. Liquidity pocket, bull zone, bear zone. And what you would eventually be able to do is you would click a point in time. If I click right there, it could give me guidance on these are the types of trades Matt likes to do here. And then drop some boxes on here that you can move them around, type in your positions, and really design your trade on the chart itself. That's the ultimate goal. The first step is to draw the map for you. The latter step is what we call Trade Planner, which will actually let you plan your trade. You can type in the expiration. Okay, I picked this day. And it'll say, okay, well, at this price on that day, it's not bull and not bear. Not bull, not bear. Selling calls, selling puts. So if I pick this strike, the algorithm would say, oh, it's not bull, not bear. Okay. The types of trades that allow you to sell calls and puts. This is the expected volatility. So that is where I'm going to sell my calls, and that is where I'm going to sell my puts. Okay. Boom and boom. Yeah, the automated process would be easier to grasp for sure. So the idea is it allows you to know, using just Greeks alone, the outcome of that trade that you want to do. So imagine like right here, if I were bearish, that's great until Friday, okay? That's good. But notice that after Friday, going into Tuesday, tell me something, class. Is this bearish or bullish? So while this is definitely bearish for Friday, if price stayed anywhere, even if price fell to here and was closing here on Friday, is that bearish for the next week? Is that bullish for the next week? Or is that neither? What do you guys think? A little lesson here. Neither. So if I were bearish, I'm only bearish through Friday. And here, it's neither bullish nor bearish. It's indecisive, right? So from here, I'm neither. Because beyond this Friday, the next day, it's kind of in that what we call liquidity pocket. And remember what happens in liquidity pocket. Remember? Liquidity pocket. Tell me, what happens when the market's liquid? Bulls are losing, bears are losing. Right? It's random. So it's neither bullish nor bearish, and it's random. So if I have a bear position going through Monday, then I'm flipping a coin. If I have a bull position going through Monday, I'm also flipping a coin. Yeah, it likely wants to stay inside of this range more often than not. It's going to take a catalyst to break through it. The first thing I do is I'd say, why is that very volatile going into that particular week? So what we tend to do is another trick. Wow, I love this video. We're doing all the tricks today. Is I'm going to go to next week and I'm going to look on the calendar and let's find out which, let's just go ahead and see which catalysts we have coming up that next week, right? Here's your ISM numbers. You got non-farms. Again, it's a huge week, right? It's a big part of inflation is the non-farms, right? ISM non-manufacturing, ISM manufacturing. You got non-farms. You got a lot of stuff coming up that week, right? And it's a holiday week, right? So it's gonna be light. Fewer traders, big hitting. Jolts are a huge deal as well. Now. Not going into why that is, but the two most important things are going to be unemployment filings and jolts for inflation. Cover that tomorrow. Come back. I'll talk about it. Huge news week, right? Non-farms. Wow. Ooh. ISM, manufacturing, non-manufacturing. Jolts. Holiday when nobody's trading. Illiquid. Right? Unemployment rate. All that stuff's coming out. Huge news week, right? So once a month news events coming up on a holiday week when everybody's traveling. Illiquid because not a lot of people are trading, so the volatility is expected to be higher. People are hedged a little further out because big news events and not a lot of traders. Very light week and the beginning of the year. Beginning of the year almost always creates direction as people enter positions for the year. So when I see this, I go, ooh, there's got to be a lot of things in the news, and we just showed you. And it's a little amplified because it is the new year, which will cause additional behavior, but fewer traders, so less liquid, more volatile. Holiday weeks tend to do that, or Fed weeks, or whatever. So how much the liquidity pocket boundaries change every day? So every day, Bright, you would wake up and remap it out. The further out in time, these things may slide up or down a little bit, but you won't wake up one day and it just drastically have changed. Right? Here's an example of QQQ when I mapped this out way back here, right? QQQ was bullish on the bull side, right? People are trying to short the market there. What was on the bull side, right? And we were maintaining our bullish thesis. As the market started losing this particular setup, it's not shown here, but we did fall to bear side really rapidly. And so we were talking about the bull thesis being over. But as you know, when market moves and we're trading here, I mapped out 1, 2, 3 weeks in advance, and I said market's bullish for the next month. And lo and behold, it wasn't bearish. It kept trying to trade higher, just wasn't enough people trading. Not bearish. I watched Furu gurus all day long, try to short the S&P and QQQ this month, and I watched them all day long blow up their accounts, right? easily seen bull side, bull side, bull side. Now that's a very far dip to maintain the bull side, but it's like, okay, I'm long the market, long the market, long the market. I'm still long, and in case we fall to here, I'm gonna grab that dip right back up to hope it stays there. So even so, right now we're on the bear side, it's like if I'm shorting the market and we rally to there, I'm doubling down on my short to stay maintain on the bear side. But since if the market rallies to here, oops. If today, pretend that you wake up tomorrow and the map is like this, okay? Or you wake up on Monday and it's like that, or Tuesday. And the market has closed right here, and you had some puts. Well, clearly you're on the bull side, so chances are that's more likely than this. So I would get out of my short. And again, that's how I do this. I don't want to, and the rules are I don't want to be short on the bull side, I don't want to be long on the bear side. In the middle, I bet that it doesn't go either way, so I like to sell on that side and sell on that side. And timing. Now, timing is the next step, and I'll cover that maybe in tomorrow's session. Say that you have this and you have this, okay? The coolest part about monthly map will be timing your expirations, okay? You can see that as people are willing to long the market lower as the weeks go by, sentiment, if I were to draw on a chart, sentiment is becoming more bullish over time. Right now, I need the market to be 280 for I trust it as a long, but next week I'll buy it at 270. Next week I'll buy it at 260, whereas this week people are shorting at 260, right? So the sentiment at this price flip-flops 2 weeks out. That's how the maps work. So if I want to be a bull, if the map looked like that, then I need to be a bull at least 2 weeks out at this price, because Wall Street's bullish there and bullish there. So I wouldn't buy 2 week expiring options. I'd buy at least 3 weeks or 4 weeks out, and maybe add a month to that just to be conservative, so the theta decay is less. So I take the distance to where I go into the zone I want, and then I double it and get that expiration. Make sense? Timing is the best part of a monthly map, which I can cover that. So let's actually just, now that I talked to you guys about this, let's just keep going with the cues, right? 3, the 6, do a couple more, 13. Couple of ranges, 270 and 235. 270, 235. And then we have like another resistance at 285, which is neat. There's let's see this here. You guys like this? The 280. So I'll cover one more topic, and then we'll call it a day. So you guys like it, make sure you grab that free trial. Please have fun with it, because as we're developing these things, you guys are going to have so much fun seeing it unfold live, and get all these new styles and tools that can help you can plan better. Like, you have tools to plan now instead of tools to not plan. So this is a neat little map. Let's kind of draw it out, right? Let me use like green for bull. Okay. Right. So monthly expiration is always the most important date on your chart. That is like all the big money positions are shifted more than any other time. So you can see that like we're bullish here. That part's easy to see. Right? Bearish there. That part's easy to see. So at this price, over the course of the month, it is never bullish. So I am not longing calls to bet on bull direction. This price is bearish now, neither for 2 weeks, and bearish again here. So if I'm swinging the bear side, I need to go at least to this date and further, not these 2 dates, and this date's okay too. An interesting mechanic happens here when you have put walls above call walls. While we call this a liquidity pocket, When the colors reverse, the puts are above calls, we call this an illiquidity pocket. These are your breakouts. So on this particular day, or this week, if the market's bullish, illiquidity pockets, while liquidity pockets left to hug the middle and squeeze everybody else out, this is when everyone's beating the house. So markets hate the middle and actually will very rapidly pick a direction. So if you're on the bull side here, I bet that it hits that wall and then there's that resistance. We blaze through it. So the way we would draw like an illiquidity pocket would basically be like something like this. Actually, I'll do a different color. Just like a caution to let you know. Okay, by the way, this is a breakout zone. It's very illiquid through here. So anything that hits through here will rapidly go to there. So if I'm long some calls, I would certainly exit my trade there because again, it's bumping the resistance. So monthly map would kind of draw it like that. So if any point in time we are up in here, then I know that I'm likely to break out to there by that date. So maybe we get to the top, I can sell my calls. Maybe we get to the top, I can buy my puts, whatever the case may be. It also shows these like breakout ranges and then the balance ranges there. So here, if I wanted to be bullish the market, I really have no evidence to be bullish. I have the best chance to guess here and here when maybe the shorts can squeeze, but no longing calls here, no longing calls for that date, because that's bearish, that's bearish. This is like, okay, coin flip, maybe I can get it. Maybe I can bet on this catalyst or that catalyst going bullish. So if I wanted to YOLO call the market by longing, I would buy calls for this date at that strike and this date at that strike. And as the market's here, I can buy these calls and those calls. If the market falls a little bit more, I can buy some more. Market falls a bit more, I can buy some more. The same call, same strike. And if we enter the bear zone, then I'll close them out. But as long as we bounce off of something like hedge pushers or monthly, I can keep adding to my position to get them cheaper and cheaper and cheaper. And then now I got my coin flip to really get in there with the lower cost basis. 1,000 ways to trade it. So when markets are bearish, I tend to like to stay out and not do much and just kind of wait, map it out a month and say, ugh, we have like a really shitty month ahead of us, right? And every morning you wake up and redo this just to see how it changes. And then you can adjust your position or adjust your thought process after that. I would say in general, it's crucial in this in any bear market that not necessarily is riddled with volatility. Like right now, we're in a bear market that's kind of like stabilizing and slightly drifting lower, but not necessarily collapsing. Any market that's in this particular environment, you will have a high correlatability between the stocks and the index. So the stocks will all go up and the index goes up, the stocks will go down and the index goes down. People aren't necessarily stock picking just yet in this environment. So right, monthly map the index. If you want to long a company or short a company, you have to keep in the back of your mind what the index is doing as well. Now when it comes to earnings season, this earnings season is going to be different. Stock picking is going to be the way to go in quarter one. People are going to need to pick the right stock that's going to have good earnings and good margins and good profits and good cash flow, the things that make a company bullish. And you're going to have half the stocks go up and half the stocks go down. It's going to be like that this earnings season as we get the reveal of how everybody's behaving in the environment where rates are going up and inflation's coming down. So which companies are able to fire the right amount of people and become profitable is your best guess. So it's all going to be fundamentals this first quarter and not really super directional. And monthly map is proving that because, I mean, we know that because we know what traders are doing. Everybody's in their positions and not really doing much. Like here, bulls are bullish and bears are bearish already. Right? So nobody's likely to act. Everybody's holding losing positions because market's likely to stay balanced for a couple of weeks. Round into the new year. People aren't bullish or bearish, which is okay. Because they're likely waiting for earnings season to pick whatever stocks. Right? The index itself is neither bullish or bearish, which means half the stocks will go up and half the stocks will go down. And that's expected. When I see like a balanced index, I say half the stocks up, half the stocks down. Which you can expect. Is Tesla going to have great earnings? Maybe good revenues, maybe bad sales. Maybe bad profitability. Maybe lower Margins were lower, maybe they didn't make a lot of money. They laid off a bunch of people, maybe they turned that into something else. Maybe they made money, maybe the bottom line improved. So it's going to be a crapshoot going to earnings, and most traders are saying that right now instead of trying to predict direction. So at the end of the day, going to earnings season, it's going to be like, I would bet that the market's going to go nowhere for a quarter, and that's my thought. So I can't wait to get Ashton here, start training on butterflies and condor type trading, which are option style of trading that bets on high volatile markets that go nowhere. It's a proper type of trade if that is your thesis, that the market's going nowhere. So if you want that, so if the bull walls are going down, it means that people are willing to buy at a lower price. So at this particular price, like for instance, if where my mouse is, if the market falls below here, people are no longer bullish for this week. But last week they're relaxed. Yeah, we're bullish, but it has to be a week out. So if the lower boundary is lower as the weeks go by, people are becoming more comfortable being bullish over time. Here, people are becoming less comfortable being bullish over time because they require a higher price to confirm where they went along. If the upper part of the bear zone, people are shorting from here, but they require a lower price to short, they're less bearish over time as well. So from here to here, people are less bearish, and from here to here, people are more bullish. But from here to here, they're less bullish, and here to here, they're less bullish. Here, they're samesies. They're willing to short higher, more bearish. So people are less bullish this week. Less bearish this week. Same, more bearish that week. Less bullish, less bullish, less bullish. So as the week goes by, you can interpret this as the market's flat and stronger bearish sentiment starting that week. Pretty cool, right? Thanks for joining Rocket Scooter stream. In about 2 weeks, we'll be doing our Futures Trading Challenge. Got ourselves monthly maps coming out this month. This month, we have a huge server transfer. Data optimization is our current project. This will be going nonstop. We have a bunch of stuff being developed. Monthly maps being one of them. Automated lines on the charts, that's coming up after that. The liquidity maps being drawn. Getting futures data is coming on after that. We can get doomsday, risk intervals, yellow lines, red lines, everything in there. And then probably by summertime, the super strategy we talked about with just the one arrow and the alerts should be out, hopefully. Yeah. Futures trade's very different than options. Very, very, very different. Yes, yes. Love you guys. And we will see you later. Don't forget, free trial, 7 days, no credit card, literally nothing to lose. Check it out, learn the stuff, watch the videos on your favorite exploits, send me a message. Hey, I trade this, trade futures, which are the best indicators? I trade swing, trade options, whatever. We got indicators for everything. We can guide you to what to look at, what to watch. Discord is free. Take a look. Link to buy it. Link in the description below. Head on over to rocketshooter.com. Try the free trial, 7 days. Trust me when I say you're gonna love it. Different way to think, a little bit of learning curve, but this is the world we live in where different is king. When different, that's where we are. That's where we certainly are. So give us a check. Like the stream on the way out. We love you, and we'll see y'all tomorrow.